My mortgage is up for renewal and I can't renew. Or my landlord's mortgage is up for renewal and now they want to sell my place. Now what? Ted and I discuss it starting right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
We are recording this podcast in the fall of 2022. I believe it is the month of October right now.
And it was very cold this morning. Frost on the grass.
If I'm not mistaken. Mortgage rates are up. Real estate prices are down. That's all true, right? That's factually correct. So what happens if my mortgage is up for renewal and the lender says no? What do you do then? Now, before we get into this discussion, I want to be clear. This is not just a show for homeowners because many of our listeners are renters. And if the landlord owns the house, is renting it out, and now their mortgage is coming up for renewal, well, that does have a ripple down effect to renters as well.
Well, that and real estate is the last bastion of financial security. Once home ownership and then investments in property start to become into question, then you know the whole system's fallen to hell.
Yeah, so we will be having many shows over the next year, I think, where we will be discussing what's happening in the world. So,
right.
So let's start with the obvious stuff then, and then we can go into a bit more detail here. So the first question I'm going to ask you, and you'll notice the people who are watching on YouTube, Ted gets no cue cards. So we're making him do this all out of his head here because I think that's more fun.
Shoot from the hip.
Shoot from the hip. So
more
the first,
likely to make a mistake.
First question, really easy question. Right. Everybody watching this should get the answer to this too. So we start off with the softball questions. And that is, I go get a mortgage. It's for like 25 years. So does that mean I'm renewing every 25 years?
All right. So that doesn't mean that in Canada. So you've got amortization period and you've got term. Term is how long have I been approved for this contract or when does it come up for renewal? Amortization is how long am I going to project this contract, assuming it gets renewed at every one of the term expirations.
And so a typical term would be 1 year, 3 years, 5 years, something like that.
Yeah, that's right. For mortgages, it's usually, it's 1 year if you got a bad rate, 5 years if you're getting a good rate. Depends on how clever you are.
Well, and what do you think the expectations are for the future, too?
That's right.
So if you were renewing your mortgage in the summer of 2021, then the correct answer was probably go for as long as a term as you could get.
10 years.
Because interest rates were going up. So, okay, so let's assume now that I am at the end of my term. Maybe that was 5 years. And it's now time to renew. How does that process normally work? Is there some fancy thing involved or what happens?
So in a normal market, and I'm going to start by saying that we're not in a normal market. So normal market means prices are stable, interest rates are stable. The world isn't looking at a recession. We don't have idiots in Ukraine killing people, all that sort of crap. Normally, when you go to renew your mortgage, it's just it's an automatic process. The bank says, "Yep, we've approved you for renewal." You sign something that renews, and it just carries on.
Yeah, they send you a letter. Do you want 1 year, 3 years, 5 years?
Just as a point for people, you should almost never agree to that because if you call and ask the bank if things are in a good shape and you've been processing your payments properly and all that sort of stuff, by asking, you could probably get a quarter point taken off whatever rate they're offering you when you do renew. So don't just let the automatic thing happen. That's got nothing to do with today's show. It's just a point for the future.
Well, since we're going off on tangents, isn't that true of everything? Like, your car insurance, your home insurance?
You almost always have to shop around with your car insurance or you're not going to get the best rate because in year 2, 3, 4, they figured, we'll just bump it up 10%.
Yeah, your cable at home, you've got it bundled with your phone and your internet and everything. Do you not, should you not ask? Okay. Right. Let's try to keep the show on track.
Let's go back to
thing. So I get this, the bank typically will just say, "Hey, what do you want?" What are the chances in a normal market that the bank would not allow me to renew my mortgage?
So the bank's only going to not renew in a normal market if you've had payment problems. If everything is status quo and going along hunky-dory, that's a nice term, there's no reason for the bank to refuse you. So there has to have been some kind of trigger that made the bank say, wait a minute, we don't want to renew this guy.
Well, if you think about it, if I'm renewing after 5 years, you would think in a normal market, the house is worth more.
Yeah, even if it's only gone up 2% per year. So now it's worth 10 or 11% more than when you bought it. And you've been paying down the mortgage. Admittedly, in the first 5 years, it's not a whole hell of a lot. But so the asset's gone up in value. The mortgage has gone down in value. Renewing it seems to make sense.
It's a no-brainer because if they were willing to lend you at a lower value and a higher mortgage 5 years ago, well, then it's an even better deal for them today.
So again, there has to be some kind of triggering event that's happened for them not to want to. And that's one we're rolling it in now, which is not a normal period. So now we've got, well, as you said, prices are declining, interest rates are increasing. Employment is less stable than it was. Inflation is driving everything crazy. So right now it's, I don't know, the bank's saying, can you afford to keep this house? Can you make the payments?
Yeah, and to be clear, as we're recording this, we're not getting a flood of calls from people who cannot renew their mortgage at the big bank.
Right. It's too soon for the interest rates to have gone up for that to have rippled through.
But we're being proactive here, and there are some spins we want to talk about. Okay, so let me give you a case study that I just made up.
Okay.
It's totally fake. I just made it up.
Totally fake.
A year ago, Joe sold his house for $1 million and bought another house for $1.5 million. Well, that's a pretty common thing. That's what upsizing means, right?
Joe always does that.
It's always Joe. It's always somebody named Joe.
It's a plumber.
And when he did it, he ported his existing mortgage. So he had a $1 million house and he had a $600,000 mortgage that still had, 3 years to run on it.
So he just took the old mortgage and applied it to the new house.
And that's what porting means.
Right.
And how hard is that?
The banks are quite happy to do that, as long as the asset value is similar or higher.
Yeah. So, and the reason you would port your mortgage, particularly today, is
because you probably got a better interest rate whenever you got the mortgage in the first place than you get today.
There you go.
Yep.
So if I've got a 5-year term and I'm 2 years into it or 3 years into it, well, and I'm selling one house and buying another, I don't want to pay off the first mortgage and get another one because I'm now paying a higher interest rate.
Right. It doesn't make sense.
Doesn't make sense. So I poured it over, meaning, okay, instead of being on the old place, it's now on the new place. And so you got to go through a bit of hoops with the bank and fill out a form and whatever. But as you say, if you're buying a house that's worth more than the one it's already on, why wouldn't they do it? Their security is still the same.
Yep.
So in this particular made-up example, he had a first mortgage of $600,000,
right,
which he's porting over to the new place, and he's buying the house for $1.5 million. He's got $300,000 in cash, which means he needs another $600,000. So he goes to a private lender to get the other $600,000.
Right.
Why would he not just go to the bank? I mean, we already answered one part of the question is he's not going to get a completely new mortgage and blow away the old one. Why would he not go to the bank for the other $600,000, or why would the bank potentially not give it to him?
Well, so reasons he might want to go to a private lender is if he knows somebody that's going to give him a great interest rate because of all the equity he has even in the new house. So he's got $600,000 on a first, $600,000 on a second on a house that's worth 1.5. That's still a pretty good ratio. So you should qualify for a decent interest rate. So he might want to do it. If the bank wasn't interested in giving him that second mortgage, even at, current interest rates as opposed to the good rate he's got on his old one, then it means they don't think he can afford the payments. And so private lenders can do whatever they want to. The contract can be written and that it's interest only, or you make balloon payments, or the interest is deferred and it compounds. There are all sorts of things private lenders can do that a bank won't do. But if a bank won't approve you for a mortgage, that's a pretty good sign that you shouldn't be applying for a mortgage.
And we're going to talk more about private lenders. Now, you use the word ratio. I understand what that word means. In the housing context, the word is LTV. So tell me what that means.
Beats the hell out of me. LTV.
Loan to value. So what would an 80% loan to value mean? Well, if I got $1 million house, then the maximum mortgage would be $800,000. That's what.
And so in your example, where it's 1.5 million, 80% of that is.
I can't do that in my
head.
head.
$1.2 million.
$1.2 million. Well, so there you go. So he ended up with an 80% mortgage, but he split it between the existing bank and a private lender. So let's assume that this story I just told you happened a year ago.
Okay. When
he bought the new house. Since Joe got his mortgage, the appraised value of his house, which he paid $1.5 million for, has dropped by 20%.
Okay.
Which is a totally realistic scenario if he happened to buy right at the absolute peak.
So it's now worth $1.2 million.
It's now worth $1.2 million. Lenders don't want to go more than 80% loan to value, so the maximum would be $960,000.
So he's underwater 240 as far as the lenders are concerned.
So now again, like you said, private lenders, they can do whatever he wants.
That's right.
But a very common scenario is, okay, I need some more money, so I'm going to go to a private lender because the bank says, you don't qualify.
Right.
But I'm going to get a 1-year term.
Mm-hmm. It's always 1 year.
Always 1 year, because I know that a year from now, my house will be worth 20% more.
Yep.
I'll have another year of history paying off my mortgage. Everything will be great. Unless everything isn't great.
Right.
And that's
what's happening now.
And that's where we are now.
Yep.
So Joe is sitting there going, okay, what I want to do is say to my bank, now that my first mortgage is up for renewal and I timed it with the private lender that the second mortgage is also up for renewal, let's just roll them all together.
Right. The bank won't do that now because he's now at your LTV of 100%.
He is, he's over 80%. Now, again, banks can go to higher than 80% as well.
Sure.
In fact, they do it all the time.
If they're willing to get fired.
Well, they have CMHC insurance. That's what CMHC insurance is for. Anytime there's more. Now, they're much more willing to do it on a purchase than on a refinance.
Right.
And we're not mortgage experts, so we're not going to go into all of this. I did a podcast with Ron Butler a few episodes ago. You can watch that one. Of course, there's a couple other problems too, and that is that if you are refinancing, you may need to pay for lender fees, brokerage fees, legal fees, appraisal costs, exactly. And that all gets rolled into the mortgage. So even if you're at the 80% loan to value, when you throw all those costs in, now I'm offside. And of course, interest rates are higher. And that matters because banks do a gross debt service calculation.
Right.
Which means I can only borrow a certain amount based on what my income is. So this is how the problems are created. Now, again, we are early on in this cycle.
Right.
I've had a few calls from people who said, hey, I bought a house in February and I didn't take possession until April. Mm-hmm. And now I'm paying, and I got a variable rate mortgage because that's what I was told to do because the rates were cheaper. And now I can't afford it. What do I do? I think we're going to get a lot more of those calls over the next 6 months to a year. Do you agree?
Oh, I agree. I mean, I had somebody in last week that they've got private money for their first 4.45%. The lender said, I don't want to renew your mortgage. And they went back and begged because no one else would approve them. Then the lender said, sure, I'll give you another year at 14.45%.
This is an actual true story.
This is a true story. And so this is exactly.
Okay. Well, so what's the answer then? What did you tell this person?
The correct answer is, because they're not underwater yet, you should really give serious consideration to selling the house.
And how is that conversation?
Unless the entire family is on side with selling the house, that's just a good way to make a mess of a relationship.
Yeah. And and I had that conversation with somebody last week as well. Yep. And this particular person, I believe, still has, even though the house has gone down a bit, she's owned the house for a number of years.
So she has equity.
Yeah. She's got a couple of $100,000 worth of equity.
Right.
And now she's not making a huge amount of money at her job because she got laid off during the pandemic and hasn't been able to replace her income fully, but she is working. She does the money coming in. And so I said, well, if you sell the house now, you end up with $200,000 in your pocket.
Right.
So you go rent a place. And she said, well, I don't want to do that because, what are all the reasons people don't want to rent? What's the pushback that you typically get when you talk about that?
So the most common one is, house is a good investment. I'm going to make money over time. Renting, I'm just pissing the money away. Mm-hmm. And we've demonstrated mathematically a couple of times that that's not always the case, particularly right now. That is definitely not the case. Yes. If you bought a house in February and you're selling it in the fall or the winter of 2022, you almost for sure lost money. So that's the exact opposite of a good investment. Now, if you bought a house 10 years ago, then probably you're still making out okay.
Right. You almost couldn't lose money unless you
refinanced it over and over again to pay off your credit card debt.
Now, you mentioned the math. Okay, I'll tell you the math. Yep. My mortgage payment is $2,000 and rent is $2,200. There's the math.
Right. But you got to remember your property taxes. You got to remember the maintenance costs of the unit because you now own the home. It's not a landlord that's got to paint and repair if something goes wrong with it. Basically, if you own a house, the costs are something like 25% more than if you were renting something similar. And that's just a rough guideline.
Well, and you own a house.
I do.
And you've had to pay for things like a new roof and a new furnace and a new this and a new that.
That's right.
And those are big numbers.
Right. And if you're really disciplined, and nobody is, including myself, you set aside a plan and, okay, I'm going to have to replace the furnace every 15, the shingles every 25, and you kind of budget for that coming up. But they never go when they're supposed to go. They always go when it's the least opportune moment. I mean, and if the furnace goes, you can't wait for, I budgeted for this 3 years from now. You got to do it now. If the shingles are gone, you can't put it off.
And when things go, they always go in threes because that's the way the simulation is programmed, right? So like if your washing machine goes, well, then your dryer is going to go next.
Right. And probably the fridge is on its last leg too because they're all built by the same guy and it's the same.
Well, and you bought them all when you bought the house.
Right.
They've all got to, yeah, exactly. So they all go at once. And that's where the killer comes because now instead of just pumping out my $2,000 a month for rent, now I got to come up with $8,000 to fix whatever the thing is that's broken.
Right.
And now I'm pooched. So, okay, you're having this discussion with this person and your first comment, and I know when you're having these discussions, you don't just come out and hit them with it, but
not usually.
It's okay. Well, and the way I explain this to people as well, you got a number of options.
Right.
One of the options is you could sell the house.
Right.
And they always go, well, no, I need a place to live.
Okay.
A house is a good investment, which over a 20-year period is probably true.
Well, so then the answer to that is how much are you willing to pay to stay in the house? Because that's really what it comes down to. If you can afford somehow to make the payments to stay in the house, then that's a viable option for you. In a lot of cases, it can't. And once you break it down into the black and white, you realize you may not want to sell the house, but it may be the only option that's realistic for you.
So under what circumstances is a house not worth keeping? In other words, when should you sell the house? So,
right. So the house is underwater. And by that, I mean you actually owe more than the house is worth. So in this particular example, the guy's house we think is worth now $1.2 million. His mortgages are $1.2 million. So it's, all right, what's the advantage of staying in it? Let's say the market continues to decline and now his house is worth $1.05 million and he owes $1.2 million on it. All right, so how long do you keep making those payments, hoping that at some point the house is going to go back to what you bought it for?
Yeah, and this is not a fantastical, crazy thing you're talking about because there are lots of people who bought a house with 5% down.
Right.
And if the market goes down 5%, well, you've lost your entire equity. I mean,
and it's already corrected more than 5% this year.
That's right.
So they're underwater.
Yeah. Now, of course, we're talking about someone who bought at the absolute peak. If you bought 2 years ago, okay, you probably still are on the plus side. But if you were to sell the house, you got to pay a real estate commission.
Yep.
Which can, be 5% or whatever it is.
There's moving costs and everything else.
Legal fees and all the rest of it. Penalty to break the mortgage if you're actually selling. So it's not that crazy to think about being, underwater on a house. And a house is the most leveraged type of investment you can do.
Right.
I mean, I know you're a big stock speculator and
sure I am.
Crypto trader and all the rest of it. When you log into your broker app there to buy a stock, if you're buying like one of the safe stock, like one of the big banks or something, you can put up 50% of the money and they'll give you the stock. That's 50% margin.
Mm-hmm.
When you're buying a house with 5% down, that's 20 times leverage?
Yeah. Mm-hmm.
So really easy to get wiped out really quickly, which is something we're going to see. Okay, so when should I not keep a house? When is a house not worth keeping? So one of them would be when you're underwater. I guess you've already mentioned that I'm in a declining market. Yep. It's going to likely go
It's going to get worse before it gets better.
Right. And then I guess there's all the lifestyle factors. So you got kids. You might end up with a new job somewhere.
Right. Well, I got to make more basic than that. I mean, I'm in my 60s now, and
you're in your 60s. Holy crap!
Once the kids move out, does it make sense?
You have kids in your 60s
that we have a house?
Oh my God, we got to be doing a show on that. Sorry, continue.
What do I need a 6-bedroom house for when everybody's when it's just me and the wife?
Right. So, and that's exactly it. Kids are moving out, so I'm going to have to downsize anyways. Right. Would I not be better off downsizing now? Rather than a year from now or 2 years from now when I'm going to be downsizing anyways.
If one of the options was to think about selling the house, I mean, if there was nothing going wrong with you, you wouldn't sell the house in this market because it's declining. But remember, we're predicating this with there are other things going on and you're in trouble, right?
Yeah. And if I can sell my house and actually have some money in the bank, and I realize it's hard to find a place to rent these days because a lot of people have sold their houses and are renting and the whole market is crazy. And if you do have 3 kids, to use a completely made up example, you can't move into a 1-bedroom apartment. Right. You've got to find a townhouse, a house you can rent, whatever, something that's big enough for the whole family. And you've got like dogs and cats and kittens,
a menagerie,
and all that sort of stuff. So, okay, there's more than just the financial element to it, but certainly something worth considering. What is the sunk cost fallacy?
Well, that's so you've already spent the money, so it's good money after bad, or you've made a mistake and now you're reinforcing that mistake. Think about any of those descriptions work, right?
Right. And so I'm a big believer in not worrying about the past. Okay, going forward, what's the best option for me here? Possible job changes as well. It's like, well, okay, I got laid off here and maybe I've got to move to Alberta.
Right.
Because everyone wants to live in Alberta.
Well, so you certainly are more flexible if you're a renter than you're an owner.
Exactly. And so even if you've got a 1-year lease or whatever, well, okay, it's still easier to move when you're a renter than going through all the hassle of selling and all the rest of it. So there's a bunch of reasons why you should certainly consider selling your house. And what I always say to people is, look, let's look at actual plan A, plan B.
Right.
So if I was to rent a house, where could I rent?
Right. Would it be in the same school district if you got kids? Will it allow you to commute to work for more or less money? Like, yeah, what are all these non-factors that you got to look at?
And so you go online or however one finds a place to rent, talks to a real estate agent, whatever. Let's see what is available to rent that meets those criteria. The same school district, near my school, whatever. And
what's it going to cost?
What's it going to cost?
Right.
And if the answer is, well, I could actually rent a place for, X number of dollars. And when I add up my mortgage and property taxes and maintenance and everything, and it's the same or higher, and I can sell my house and end up with cash in the bank, it's really not that, it's an easier decision to make.
Right.
Now, what happens if in this whole scenario, it's not just a house issue, I've also got a bunch of unsecured debt too?
Well, and so in most cases, when somebody's contacted us, that's the example that they're living with. It's not that the house is the problem. It's they've got all this unsecured debt from either trying to keep the house or to deal with all the other things because they're, have you heard the expression house poor?
Yes, I have. Cash rich, house poor.
That's right. All your money is tied up in maintaining the house and staying in the house. And so when something does go wrong, we talked about it earlier, the furnace, the fridge, the dryer, whatever the hell it is, they end up buying it on credit. So now they've got the house, which is things are really tight, and all this unsecured debt that they can't deal with, and the carrying costs are just too much.
And we know for a fact that of our clients over the years, if we go back over the last 10, 20 years, because I'm pretty old too, and we've been doing this, Hoy's Michalos has existed, I think, for 24 years now. If you own a house and end up coming to see us, you obviously have unsecured debt, and you have more unsecured debt than a non-homeowner.
Right.
So the typical client who would come in to see us to do a consumer proposal or a bankruptcy might have $50,000 of unsecured debt. A homeowner, it's more like $70,000 or more.
And the reason they can do that is they've got this nice asset that at some point had value and equity in it, right? So they're a better risk for the bank, so the bank will give them more money. And of course, if the bank will give you more money, you'll use it.
And particularly if things happen and you need to draw on that credit, well, there you are. So the lady I'm thinking about who I talked to last week, she has a chunk of debt, I don't know, something like, let's call it $50,000. If she sells her house, she can get $200,000.
So pay off the debt, have $150 still left, and she's clear. And her life would be so much less stressful.
And that's what I told her. But again, all the other factors, but I've got a kid and I've got a dog and I don't want to lose the house and all the rest of it. So, okay, we've talked about the options. The first one is sell the house. And that's something that you and I, we go through and we try to show the numbers, but obviously not everyone is going to agree to that option. The second option then would be, well, I guess I can I can refinance maybe for a year with a secondary lender. Perhaps I can talk to a mortgage broker, get a private lender. And I think we've already made this point, but a private lender doesn't really have to follow any specific rules. They can do whatever they want.
Yep.
So with a bank, it's like, okay, the loan to value has to be this much. The debt service ratio has to be this much because the only product we've got is this bank mortgage and we can only charge you this much interest.
Well, and there's half a dozen people that have to approve it at the bank. With a private lender, it's okay, this is the deal I want to do you.
Right. And so the private lender might say, well, I don't really care at all about your income. All I care about is the value of the house.
Right.
Or they might say, I'm not so worried about the value of the house. I really care about what your income is.
Yep.
I mean, they can base it on whatever they want. But by going with a private lender, you're paying more.
That's right. So earlier in the program, I said, if you really want to keep the house, you got to decide how much are you willing to pay to be able to do so. And if you're willing to pay and you're able to pay, you don't have to lose the house. And so one of the options we got to look at now is, well, are there ways to reduce our other costs so now we can make the house more affordable, or at least make it so that the house isn't at risk because we're dealing with all this unsecured debt and everything else we were talking about.
Right. And the problem is if I do refinance and my interest rate is a lot higher, now I've got that much more money going to the debt, the mortgage.
Right.
Which means I don't have money to service my other debt, or I have less, or maybe even worse, I now have to get into more unsecured debt to service that. That's clearly a big problem. And just so everyone knows, in the month of August, the Michalos Homeowners Bankruptcy Index, for the first time ever, hit 0.
And so that means the people that filed with us in August, consumer proposals or maybe a bankruptcy, they weren't homeowners.
Which has never happened before. There's always been 1 or 2 or 3 people who owned a home, but the equity was so small that it wasn't a big issue. I think that has obviously the bottom can't go any lower than 0.
Well, but historically, so we're talking now 15 years ago, it was what? 33%, right?
Around a third. So if you go back to 2011, it was around a third, and that's probably where it will trend up to over the next number of probably years, not months.
Right.
So what happens if I file a bankruptcy or a consumer proposal because I got all these other debts, but I also own a home? What happens in that scenario?
Well, so let's deal with the bankruptcy first. When you file bankruptcy, you're saying, look, I can't pay my unsecured debts. And in exchange for that, you sign over your things that have some kind of net worth or value. So if you have equity in your house and you file bankruptcy, they're going to say, well, all right, the only way you can keep the house is to pay an amount equal to the equity into the bankruptcy for all those other people that you owe. That's always hard to do.
Which is why the option often is a consumer proposal.
Right.
So if we do the math and the equity in your house is $20,000, then the consumer proposal would have to be more than $20,000.
That's right.
And so that would be a way to take the value of the house and not lose it in a bankruptcy, but you end up paying it back to the creditors anyways, but we can stretch that over a 5-year period.
Right. And the reason that makes sense, so let's say you've got $60,000 worth of credit card debt, but you can do a proposal for $20,000. This is something that you're now not paying any interest, and your carrying costs are so much lower on the $20,000.
Yeah, and the reason that people who own houses are not doing proposals, this year so far, is because the equity in their house is $200,000, but their credit cards are $50,000.
Right. And that's all going to change over the next few months, possibly a year.
We think that will certainly be flipping. Okay, so let's end with practical advice. So the person who's coming into you and they're going, you know what, my private lender doesn't want to renew my mortgage, or the bank will renew my mortgage, but the interest rate's going to be a lot higher. Right. I'm trying to think of what I should do. So the first item I put on my list is be proactive.
Right.
So think ahead. When your mortgage is coming up for renewal. It's not like it's a surprise. It's got 3 more months or 6 more months or whatever.
Yep.
So start thinking ahead now. Do I really want to keep the house? If I was to sell the house, what would I get for it? Where could I rent? What would that cost? What do I need for first and last month's rent? You don't really want to be selling a house in December or January. Right. So do I sell it in the fall? Do I wait till the spring? All those kind of things.
Well, keep it simple. A house is a big decision, right? It is your biggest investment. It's where you live. It's where you sleep every night. So don't do anything in a knee-jerk or reactive way. Plan ahead. Take the time to look at it.
And consider your options, obviously, which I think is what this whole show is about. There's a bunch of different options. So to close it out then, let's just put a bow on it with this whole consumer proposal thing, because, we got to get a commercial in here somewhere.
Right.
So what's the thought process then? Is there too much equity to do a consumer proposal?
Yeah, and there really isn't. So equity is this number that banks and finance people make up to say that, well, you owe this much, your house is worth this much, so you've got this asset, this thing, this equity, but you can't tap into it, right? If somebody isn't going to lend you against it, you can't take that to the bank and say, well, I want cash for it. Then it's not real. And cash is king, folks. Just because you got lots of equity in a house, if nobody will let you use that as collateral and give you money, then it's got no value to whatsoever. But financially, it's still this roadblock to doing other things. So let's say you've got $200,000 equity in your house, you owe $60,000 in credit cards. Well, if there's no way to get at that $200,000 to pay off the $60,000, you could still file a consumer proposal to pay off the $60,000 with no new interest, and your equity is still in the house. Now, that's actually pretty common these days.
Right, but the credit card companies are going to say, okay, we understand how this works. Doug and Ted get paid.
Right.
We don't do proposals for nothing.
Yep.
Our fees are legislated by the federal government. It's a tariff. Every licensed insolvency trustee gets the same percentage.
That's right.
But it would be common in a scenario that you just said that the credit card companies would say, okay, look, we know that if you go bankrupt, you lose a $200,000 house,
right,
which means we would get paid in full full.
Yep.
So we're willing to accept a proposal. We're willing to give you 5 years to pay this off. We may even be willing to forgive some of the interest, but
You got to cover the costs.
you got to cover the cost.
Well, and so that means that on that $60,000 example I just gave you, probably you got to pay back $75,000 to $80,000. It works out to somewhere 11 to 12% interest if it had been a second mortgage instead.
Which is why our advice is, if you've got that much equity, talk to a mortgage broker, talk to your bank, see if you can refinance, because then you're not going through the proposal process. If you have no choice, then that's when you talk to us.
We're not your first choice for the actual solution, although we should be your first choice for somebody to talk to, because we're going to review all of those options with you first.
And we can walk you, and we've got, names of mortgage people we can refer you to and so on. So
right.
We're only going to do a proposal if it's actually the right thing for you. In most cases, well, certainly more than half of cases, there's probably something else that would work better.
That's right.
Now, if you've got $50,000 in equity and $60,000 in credit card debt, well, then the decision becomes easier and easier, because clearly you can't refinance to get your way out of it. So, So there you go. The conclusion is, if you are in a situation where you're having trouble renewing your mortgage, or you think you might be having trouble, reach out first, be proactive. We can walk you through the options, and you can come up with the answer that works best for you.
Yeah. And you're not alone these days. This problem is going to become very real for an awful lot of people for the next 12 months.
Yes, and I suspect in 2023 we'll be talking about this a lot. So, so stay tuned. There you go. That is our show for today. If you're watching on YouTube, hit all the little buttons, because that messes with the algorithm and gets the show out. Obviously, if you're listening on audio, make sure you subscribe. We're on all the platforms, Debt-Free in 30. That is our show for today. Until next week, thanks for listening. I'm Doug Hoyes. That was Debt-Free in 30.